What if the smartest investing strategy wasn't some secret hedge fund formula, but just 3 boring index funds? Study after study shows that most professional stock pickers fail to beat simple index investing over the long run. And today, I'm breaking down the exact 3-fund setup that keeps things simple, low cost, and effective. Here's the uncomfortable truth. A large portion of people who actively trade or try to pick winning stocks and funds end up underperforming a simple buy and hold index approach over long periods. It's not because they're not smart. It's because trying to beat the market consistently is incredibly hard. Fees eat into returns, and emotional decisions like panic selling or chasing hot trends quietly destroy long-term performance. The 3-fund portfolio is designed to sidestep all of that. A 3-fund portfolio is exactly what it sounds like. You build your entire investment portfolio using just 3 broad, low-cost index funds instead of dozens of individual stocks or actively managed funds. The idea is to get exposure to basically the entire investable stock and bond market with a handful of simple holdings, instead of trying to guess which individual companies or fund managers will outperform. The first building block is a total U.S. stock market index fund. Instead of picking individual companies, this single fund gives you ownership in a broad slice of the U.S. stock market, small, medium, and large companies together. This is your core growth engine, designed to capture the long-term growth of the domestic economy without betting on any one company or sector. The second piece is a total international stock index fund, which gives you exposure to companies outside your home country. This adds diversification, because different economies and markets don't always move in sync. It reduces your reliance on any single country's economic performance and spreads your risk more broadly across the global economy. The third fund is a total bond market index fund. Bonds tend to be less volatile than stocks and can help cushion your portfolio during stock market downturns. The proportion of bonds you hold usually depends on your time horizon and risk tolerance. Generally, the closer you are to needing the money, the more stability you may want in your portfolio. The historical pattern behind index investing is fairly consistent. Over long stretches of time, low-cost, broadly diversified index funds have tended to outperform a majority of actively managed funds after fees are accounted for. This isn't magic. Active management involves higher costs, more trading, and the difficult task of consistently guessing right. And those costs compound against investors year after year, just like returns compound in their favor. Beyond the numbers, there's a psychological advantage to simplicity. A 3-fund portfolio is easy to understand, easy to stick with, and hard to mess with emotionally. When you're not constantly checking individual stock prices or reacting to headlines, you're less tempted to sell in a panic during downturns or chase performance during hype cycles. And staying invested through market cycles is one of the most important factors in long-term investing success. To build your own version, you choose a low-cost total U.S. stock index fund, a low-cost total international stock index fund, and a low-cost total bond index fund. Then decide on an allocation based on your goals, timeline, and comfort with risk. Over time, as some funds grow faster than others, your original allocation will drift, so periodically rebalancing back to your target mix, maybe once or twice a year, helps keep your risk level where you intended it. Some people worry that 3 funds is too simple to be effective, or that they are missing out by not picking individual winning stocks. But the goal here isn't to hit a home run on one stock. It's to reliably capture the broad growth of markets over decades with minimal cost and minimal effort. Remember, this is general education, not personalized advice, so your ideal allocation and fund choices should reflect your own situation, and it's worth discussing with a licensed financial professional if you're unsure. Investing doesn't have to be complicated to be effective. Sometimes the simplest strategy really is the smartest one. If this video helped you rethink your investing approach, hit subscribe for more straightforward personal finance content, and let me know in the comments what topic you want covered next.